Have you ever drawn what you thought was the perfect trend line? You know, the one that looked absolutely textbook? You felt super confident about your trade, and then, boom, price just blows right through it like it wasn't even there. Well, today we're going to pull back the curtain and find out exactly why that happens. Okay, let's get into it.
Welcome to AI Explains ICT. In this video, we're doing a deep dive into the ideas from ICT's core content, specifically from Month 3, Episode 7. And hey, you're probably going to want to grab a notepad for this one because we're about to seriously challenge the way you look at your charts forever.
So let me just start with this one simple question. What if that trusty trend line, the very first tool that most of us ever learn in trading, what if it isn't actually a tool for you at all? What if it's really a trap, perfectly designed and set by market makers?
So here's the game plan for today. First, we're going to bust the classic trendline myth wide open. Then we'll get into what really drives the market, liquidity. After that, we'll look at exactly how market makers set these traps, walk through a couple of real-world case studies, and by the end, hopefully give you a completely new way of looking at your charts.
All right, first things first, let's talk about the alluring myth of the trend line. I mean, this is the pattern that's in every single trading book out there. You know the drill, right? In an uptrend, you connect two or more higher lows. In a downtrend, you connect two or more lower highs. You draw that perfect line, and suddenly, all the chaos of the market seems to make sense. It looks clean, logical, and best of all, predictable. And what's the textbook trade? You wait for price to come back and kiss that line for a third time. If it's an uptrend, you buy. If it's a downtrend, you sell. It seems so simple, so reliable. But if you've been trading for any amount of time, you already know it's almost never that easy, is it?
Okay, now for the truth. In this next part, we are going to completely dismantle that entire idea, and we're going to introduce the one concept that truly drives the market: liquidity.
So let's just ask the obvious question, the question that I know every single one of us has screamed at our screens at some point. If these trend lines are supposed to be so reliable, why do they break so often and so spectacularly? Why does it feel like the market waits for that perfect third touch just to immediately reverse and take out your stop?
The answer, in one word, is liquidity. So for a second, just forget the lines on your chart. The market is just a giant auction, and its only purpose is to move to where the orders are. These orders, the buy stops, the sell stops, they create giant pools of liquidity. That's the fuel for the market's engine. Price isn't moving to hit your line, it's moving to grab that fuel.
And here's the kicker. Smart money, the big institutional players, they need massive amounts of liquidity to fill their huge orders. So what do? They actually engineer price moves specifically to run into areas where they know retail traders, like us, have placed all of our stops.
As ICT himself says, price has no awareness of your trend line. It only respects where the actual liquidity is. Think about it, it's just an algorithm. It's not looking at your drawing. It only knows one thing: where are the orders? The market is drawn to those pools of stops like a magnet.
Okay, so if the trend lines aren't real, how exactly are they used to trap traders? Let's break down the actual mechanics of the trap. All right, so here's the setup from the retail point of view. We see a clear uptrend. We connect point 1 and point 2. Now, when price comes down for that third touch, everything we've read tells us to buy. And where do we put our stop loss? Right? Just below that previous swing low at point 2. It feels safe, it feels logical, and for the market makers, it's completely predictable.
But now, let's flip it. Let's look at this chart through the eyes of a market maker. They see that beautiful trend line as basically a giant advertisement. They know that a wave of retail buy orders is coming in at point 3. But their real target? It's that massive pool of sell stop orders just sitting there right below point 2. So they'll sell into the retail buying, push the price down, trigger all those stops, and use that liquidity to fuel the real move they wanted to make all along.
And guess what? It is the exact same story in a downtrend, just flipped upside down. Retail traders see lower highs. They draw their line, and on that third touch, they feel great about selling short. Their stop losses, which are buy stops, get placed just above the previous swing high at point 2. And once again, their actions are totally transparent to the institutions.
So, from the market maker's view, that downtrend is the perfect setup to get people to sell. They let retail traders sell and sell, all while a huge pool of buy stops builds up above point 2. Then, when the moment is right, they'll come in and buy aggressively, driving price straight up to trigger those stops and fuel a massive rally. The trend line, it was just the bait for the trap.
All right, theory's one thing, but let's see this actually play out on a real chart.
We're going to look at a bearish trap where what looked like a perfect uptrend was really just designed to fail. So the first rule is always context. You have to look at the bigger picture. On the daily chart here, we can see that price has rallied right up into a major institutional resistance level. Smart money is not looking to buy up here, they're actively looking for reasons to start selling. Now we drop down to a lower time frame, like the 1 hour. And what do we see? A beautiful, textbook perfect uptrend line. 1 touch, 2 touches, 3 touches. This is practically screaming buy to the retail world. It's creating a false sense of security, getting traders to go long, right at the exact level where institutions are getting ready to sell.
And here's the result. Price just completely falls apart. It slices through that phantom trend line like it was never even there. And why did it do that? Because its real destination was never higher. It was the pool of sell-stop liquidity sitting right below those swing lows. The trend line was just the trap that created the fuel for the move down.
Okay, now let's flip the script. Let's look at a bullish setup that was cleverly disguised as a weak little downtrend.
Once again, we start with the higher time frame context. On the daily chart on the left, price is sold off right into a key bullish order block. This is a level where institutions have bought before and are very likely to buy again, so smart money wants to buy here. But what do they paint on the 1 hour chart for the retail crowd? Yep, a nice clean-looking downtrend line to get everyone selling short.
And what happens next? The market breaks that so-called downtrend, and then it just rallies aggressively. And where does it go? Straight for the money. It goes right for that pool of buy stops that it knows retail short sellers have placed just above that previous high. It's the same model, just in reverse.
So, what does this all mean for you and your trading? Well, it means it's time for a fundamental shift in how you look at a price chart.
This slide really sums it all up. The old way of thinking is that price respects the lines you draw. The new, institutional way of thinking is that price only seeks liquidity. The old view says to look for that third touch as an entry. The new view sees that third touch as the trigger for the trap. You're no longer seeing simple support and resistance. You're seeing pools of engineered liquidity.
So, I'll just leave you with this one final thought to take with you to your charts. Now that you understand how these phantom lines are used to build up liquidity and set these traps, will you ever be able to look at a simple trend line the same way again? Hey, if this video helps shift your perspective, do me a favor and hit that like button. And be sure to subscribe to the channel for more content just like this. And if you have any questions at all, just drop them in the comments below. A real human will get back to you. Stay safe and safe trading.